Just like that, we're live, ladies and gents, as everyone starts to join us. And for those that are watching the repeat after we've been live, I am very excited tonight. It's the Thursday before a 4-day weekend for a lot of people, although I've got a few bits booked in for tomorrow. But I would imagine chocolate is on the agenda for most people this weekend, which is always a win. So this evening, I'm joined by Andy Meade. Andy Meade, for those of you that will have seen him on the live chats before, looks after all of the new homes marketing element of things for Avocado Property, and Meade New Homes is his business. And I'm also super delighted this week to be joined by Akhil from our mortgage broker. Akhil's the CEO there. His business is expanding and has expanded quite drastically over the last couple of years. He's been a bit of a jet setter last month, networking with people all over the place. So he's got lots of stories to tell us off camera and a couple to tell us on camera tonight as well, I'm sure. But we wanted to get Akhil on this week because we're now a solid quarter into the year. I can't believe it's already April. The property market has been an interesting one so far this year. I've got my market update dropping on Saturday this weekend, and I just couldn't believe it when I was doing the research on exactly what's happened this year with base rates, interest rates, and everything going on. So we're going to cover a lot this week. And if you've got questions for us, please do fire them into the comments. I'll show them on screen and then we can talk about them as well. So yeah, first of all, thank you, Akhil, for joining us. And how are you?
Absolute pleasure. Thank you, Ian and Andy, for having me on board. How am I? I'm tired. I'm exhausted. Mind's all over the place. But listen, I'm not going to complain. It's what we do. It's what we enjoy doing. So no complaints. Just busy.
Well, I would say a tired, exhausted, and busy mortgage advisor is potentially not what people would have thought at this point of the year if we went back 6 months. So that in itself is probably quite positive signs for the market, I would say. So are your clients quite active and busy at the moment?
Yeah, and I certainly agree to exactly what you just said. And there's lots of doom and gloom on newspaper headlines and on what we see on the news, but rest assured, we work very closely with our clients. We're in this day in, day out. And for us, it's business as usual. Yes, interest rates are up, inflation's up. These things happen. But, as entrepreneurs, as business leaders, as specialist advisors, we're here to support our clients through the thick or thin, and finding solutions for them. And, I can categorically state that, yeah, costs are up, yields are slightly lower, not as much as they were the last 10 years, but there's still margins to be had if you're a buy-to-let landlord. And remember, it's only a small fraction of people that are coming out of fixed rate mortgages this year. The vast majority are still tied into very low interest rates. So nothing changes for those guys and girls. It's more for those that are looking to acquire properties or refinancing in 2023.
Yeah, there's a lot of people that I've spoke to that are nervous about remortgaging this year because of the amazing rates they've obviously had from a couple of years back. I'm sure, Andy, you speak to people all the time. Do you still speak to many of your clients from a couple of years ago, Andy, that obviously did deals at much lower rates and now they're kind of refinancing? Are you being asked for sort of valuations from a couple of years ago for any particular clients at this stage?
Not so much valuations, but a lot of people have been contacting me recently about how they move forward, especially with Help to Buy, with that having finished, and how they then move forward if they're looking at selling theirs, how they would move forward with getting new mortgages and altering the mortgage schemes they've got at the moment. Because don't forget, a lot of people got mortgages back then at 1.5%, 2%, 2.5%. So there's I wouldn't say there's a concern, because it's even at 2.5%, even at 3.5%, 4% that we're looking at now, is still not a lot of money in terms of what we used to pay and what me, you, and Akhil, when we first bought our own houses, were paying. I think Akhil's the same age as me.
You just got more hair than me, Andy. You just got more hair than me. Actually, no, I think I'm a day older than Ian officially.
I was going to say, Akhil is actually exactly the same age as me by a day, I think. So
yeah, that's it. Yeah. But no, I agree, Andy. I think what we like to do as a team at the OMB team is actually tell the client, explain to them what the cost comparison is if they bought a property 6 months ago versus today. And yes, interest rates have gone up, but how much does that actually mean in a monetary stance? Has it gone up £50 or £30? And when we drill down to that minute detail, they were like, you know what, that's one less takeaway. Or rather than going for a 5-star hotel this summer, we're going to go for a 4-star. So it's not deal breaking. It's not super eye watering as much as the doom and gloom media states out there at the moment.
Yeah, definitely. I've just put a shameless plug on the comments here. There's anybody who's looking at buying a new home. Even now, there's still a lot of schemes available from the government, which if you click on the link I've just put on there, it takes you to the government website, which allows you to put in and see what schemes you are eligible for, if you are eligible for any government buying scheme, because there are still some out there. Have a look at those, especially if you're a first-time buyer looking at getting on the property ladder, because as much as there's all doom and gloom in the papers and what have you, the UK government want people to buy houses. Fact. And they will help as much as they can. Have a look at that. And that just gives you an idea of what you are possibly eligible for.
I've seen a lot of reports at the moment, gents, which are more from the portals, more from Zoopla and Rightmove, and some of the internal statisticians as well. They're really talking about the market in comparison to 2019 and almost trying to move away from the year-on-year element of things, because it's not comparable in terms of this year versus last year. It's just the standard way to kind of look at things year on year. But actually, when we look at things versus 2019, pre-COVID, obviously furlough and stamp duty holiday and all of these different elements, versus 2019, most of the statistics are up. Sales agreed are up year on year. Obviously, prices are massively up versus 2019 as well. Stock levels are there or thereabouts, and new listings coming to the market are up on 2019 as well. So it's really hard to kill, isn't it? Because it's easy to compare to last year, but actually we probably have to move away from that and more compare to maybe a 5-year average or something along those lines, I guess.
Yeah, and I think going back 12 or 24 months, what you just stated, is not really a good comparison, because the last 24 to 36 months have been we've had great incentives with the stamp duty, a lot of government input and all to that sort of stuff. So I think, yeah, you're right. I think if you're going to do any comparisons, you need to go back as far as 5 years rather than the last 2 years to get a real insight into it. And generally, when you and I, both of you and I included, when we bought our first properties, I remember in 2005, I got an interest rate of 5.25%, and I thought I won the lottery, But if you compare to that in the last decade, rates have been 1s and 2s. But it is what it is, and we are. What I like to stress to our clients is very simple: is there's still plenty of money to be had. There's lots of great property to buy out there, but you make money on the day that you purchase it. And then you make even more money if you can find value add opportunities, either that's via permitted development or via the planning game. So, I always say stay very close to your financial advisor, i.e. the mortgage broker. Number 2 is stay very close to the estate agent and be very specific with the agents exactly what you're looking for. Don't say I'm looking for a house worth 300,000. Well, that's fine. But mid-terrace, end terrace, flat, house, etc., HMO, non-HMO. So, I think it's more so important to be a bit more specific, have a tight power team around you. We've been speaking on record and off record about power teams for many years now, Ian, and it's pivotal that people surround themselves, first of all, with knowledge, expertise, if they are looking to become a landlord and an investor. If it's a first-time buyer, great incentives out there. Andy's just mentioned a bunch of incentives that are still available. No doubt there'll be some more incentives coming through, I think, on the second half of this year. But from a financial standpoint, mortgage lenders are offering loan-to-income multiples. I don't know if you chaps know this, but 6.5 times your income. Wow. 6.5 times your annual income, you can get a mortgage. And we're talking to lenders that are doing them as we speak. So it's unfortunate. A lot of clients don't know a lot of things because it's not what they know, what they do, and it's not what they listen to every day. It's not their daily job. But that's why I say it's pivotal that they speak to the relevant people that do this job for a living, i.e. agents as well as the mortgage advisors, because you just don't know. I've had so many clients ask me, that I didn't know that we can do a product transfer prior to my mortgage coming up for renewal. They thought they needed to wait for the renewal to occur, the product to end, to then refinance. I'm like, no, you can actually refinance up to 6 months prior to the deal ending. Also, you don't need to refinance to a brand new lender. You can stay with the same lender and they'll offer you a new product within their product range. Likewise, people think that you can only have a mortgage in joint names. They don't know so many lenders now offer mortgages in 3 applicant names and even 4 applicant names, which then enhances your mortgage loan size because they take into account all 4 incomes, for example. So if you don't know, you don't know, right? But I guess you've got to ask.
With the topic that we're covering there, kind of, you know, banks and what they're doing to make things more appealing. You mentioned a couple there. I've heard that some lenders, or maybe one in particular, I think today, I think it might be NatWest, kind of, did they say that they're happy to accept 20% annual overpayments this year?
Yes.
On mortgages. So what other kind of things are being done by the banks, you know, new homes related for Andy, or just residential or remortgage, just to try and make things, I guess, more affordable and inevitably more appealing as well? Is there any other little rumours, or is there any other changes to certain products with certain lenders at the moment, Akhil?
Yeah, so the beauty is, because lenders are knocking on our doors every day to come in, and they're always asking us, what can we do differently? What can we do more of? And what are you seeing from your clients? What are they asking for? And you know, we're all pro giving them feedback on systems, processes, and more importantly, the criteria that they deploy to their borrowers. The most important one is loan to income ratios. House prices are here, incomes are, there's still a massive divide between income versus house prices. So we want to see enhanced loan to income ratios for potentially the higher income earners, because there's less risk on those guys and girls. So that's number one. You're right, overpayments. 99% of the lenders in the market allow you to overpay up to 10% of your mortgage balance, and that's each and every year, I should say. Some lenders allow for 20%, and some lenders offer you an unlimited amount that you can overpay by, which is good, because what that means is you save on interest costs, or you reduce your mortgage term to bring it down in line with when you want to retire, or when you want your property to become debt-free, mortgage-free. What other incentives are they doing? Andy mentioned there, you've got the incentives, the build schemes, the new build schemes, loan to income ratios, number of applicants, even other parts of your income that your property you generate, so bonuses, commissions, second jobs, third jobs. They'll take on 100% of incomes for your second and third job. If you are self-employed, they won't just look at your salary, they'll also take into account your dividends if you are a limited company. If you're not drawing as much as you need to out of your limited company, you've got profits in your business, they can look at your profits within the business and your salary, so they can enhance your income that way.
So is that if you're a limited business owner?
Yeah.
And Andy is, I am, I think you are as well. So
yeah.
if you're taking a certain amount of salary or dividends only, then potentially certain banks will actually look at how profitable the business is to potentially support that as well.
Yeah, to enhance your mortgage size that you need. So we'll always ask our clients, are you a sole trader? Are you a limited company? Sole traders, we use salary and profits, and that's either before tax or after tax. Before tax is great, because obviously a bigger number. Limited company, is it salary and dividends, or is it salary and profit before or after tax? And we will assess the client's affordability looking at their tax calculations and looking at their accounts that they filed for the last 2 years. So lenders can take the average of 2 years, which is okay. But if you've got an enhancement in your latest year, we will then approach a lender that will take 100% of the latest year rather than the average of 2 years. Because businesses grow, we want to use the larger figure. So we'll approach the lender that will then take on the latest years. So, you know, a lot of clients think it's just the high street lenders that can support them. They don't know that there's a whole range of lenders out there. There's tens of thousands of products available to everyone in the market. I say everyone, depending on credit profile and everything else, but there's a bigger wide world out there, not just a high street that people can approach via us. And the rates are not too dissimilar to the high street as well. So we'll obviously try to get the most competitive rates, but it is all subject to personal credit profile, income profile, loan to value, and so on.
Interesting. Andy, you're obviously talking to buyers from a new homes point of view. I would imagine the majority of new homes typically are, I think the stat Zoopla said is in the first quarter of this year, 34% of transactions were first-time buyers. I would hazard a guess that new homes, it's even higher than that potentially from a first-time buyer point of view. I don't know, but just based on the amount of classic first-time buyer type units that are available through new homes. But I would imagine most buyers don't have that level of knowledge, from the outset. Do you think there's a lot of people out there that would buy new homes if they had more of that information shared with them because they just think they can't for some reason or another?
Yeah, massively. Yeah, I think there's an attitude that just by buying new homes you're not going to get the schemes or the affordability that you need to buy them. So yeah, there is a lack of knowledge in terms of finances, and that's why I've updated my website to put on there the help to buy schemes. Obviously, as much as Help to Buy is gone, there are other schemes that are on there. Whether you're a key worker, whether you're whatever, there are schemes that are available, and I can't stress enough to, before you do anything, is speak to a financial advisor and speak to a broker or somebody that your friends have used, or somebody that the agent that you're working with is recommending, because they will tell you exactly what's in the marketplace, and that's what you need to be understanding, is what you as a consumer have actually got access to, because there's a lot of fruit on the tree, and it's if you're a first time buyer, you can reach up higher, so the fruit's not just at the bottom, it's all the way up. So there is, there's an ability there to get that, and there's so many people that I speak to that they just don't know and don't understand the financial side of things, and a lot of that goes back to, I know you do a lot of stuff in schools and what have you here, because at school you never taught that, and it's ridiculous. It really is bizarre that you come out of school, you've got no idea how to buy a house, you've got no idea about the process. You've got no idea about understanding what to do it. Now, I'm not saying school leavers at 18 now are going to be able to afford to buy houses, but they need to understand the mechanics of it so they can then start putting in place saving schemes. They can start putting in place what they need to do. And that's the biggest problem, I think, with first-time buyers, is not really understanding the full mechanics of it.
Yeah. The other one is a guarantor mortgage as well. Sorry, Ian. Guarantor mortgages. So if you are lucky to have parents that have an unencumbered property, or they have a bunch of cash that's available, that becomes a guarantor in the background, and that can support someone that hasn't got a deposit or they're short of the loan amount that they require, and we can have guarantors in the background, and that includes parents and grandparents as well. So I always say it's good to talk, and if you don't talk, you're never going to know. Renting's not for everyone. I'm a bit old school. I like to own where I live, which I class it as an investment, although it's not income producing, but tomorrow is an investment for me and my children going forward. But goes back to, if you don't ask, you don't know. We're fortunate where we live in a position now in our world now that everything's just a few clicks away. Not everything online is true, but if you speak to the right people that do it for a living, they can certainly support you in your journey. If not today, but at least tomorrow.
Yeah.
Sorry, mate. Sorry. Going back to the rental side of things, a lot of people don't understand the mortgage your mortgage payments per month could actually be cheaper than your rental per month.
Yeah.
And they are actually, the rental you're paying is dead money. The mortgage you're paying off what you own. So it's it's understanding that as well.
Yep.
We've got a question for you, Akhil, come in here from Ryan. He said, "Hi guys, question for Akhil. Had a couple of clients being quoted similar rates for 2 and 5 year fixed options. What would be your advice on which is the best option for people? Cheers, guys. Great chat." So it's the 2 versus 5. Obviously, the rates, if they're quite similar, which would be your advice for clients at the moment?
Okay, so thanks, Ryan, for your question first and foremost. I'm going to split it up for the residential, so if it's your main home, as versus a buy-to-let range. So 2 different answers, 2 different scenarios. So let's assume that somebody's buying their first home, husband and wife just got married, moved out with their parents, 2 or a 5 year fixed. 5 year gives you certainty of your payments over obviously a longer period of time versus 2 years. Depends on, first of all, your affordability and how you think the market's going to now react between the 2 and 5 year period. The common rule is, in a high stake market where interest rates are up, you go for a shorter fixed period. When interest rates are low, you want to lock in for the longer period. Now, if you're buying your primary residence, usually lenders will lend you a bit more on a mortgage loan size if you borrow for a longer period of time, because that's the way they factor in affordability versus their investment that they're putting into you and deploying cash into your mortgage. Whereas if you're looking to purchase it as a buy to let, depending on what lender you reach out to, the 5 year might only be the option because of the rental stress test, and it might only fit on a 5 year basis versus the 2 years, because the 5 years is a bit more relaxed and the stress test benefits you as a borrower because it allows you to borrow more. Now, where we are in London and Southeast, capital values, property values are higher, rentals are sort of low to medium, rather than buying up further up north where house prices are a bit more lower, but the rents are still in line with London. So you might benefit with a 2 year fixed in a buy to let up north, whereas in London and the Southeast, you might only have an option for a 5 year fixed. Typically, if you're buying something for 300,000, 400,000, 500,000 or more, you're probably going to be stuck with a 5 year fix for a buy to let reason. But rule of thumb is, in a high interest rate market, I recommend going for a 2 year basis. If it's a low interest rate market, go for a 5 years. Do I see interest rates coming down very soon? I don't think very soon, but I think they'll certainly come down next year. But I don't think they're not going to half, that's for sure.
So I guess that is the question you answer sort of at the end there, is what's the gut feeling and what's the murmurs from the banks if we're already into Q2 of this year.
Yeah.
And we look at things. Let's talk about Q2 next year when I've got a remortgage up.
Yeah.
What are we thinking? Are we thinking rates are going to be better than they are now or higher than they are now?
Okay, so it's really weird this, because if you look at the Bank of England base rate, we've had, I think, 11 consecutive rises. Yeah, no one expected it. Some did, some didn't. It is what it is. We've had 11 straight rises. We're at 4.25. Are they still going to go up? I'm going to predict yes. Anyway, but what the flip side is, if you look at the SONIA swap rates, they're actually coming down. And what that tells you is the market, the financial markets around the world are actually forecasting interest rates dropping between 6 and 12 months time. So there's a lag in the system. It's like fuel prices have actually dropped. And now if you fill up your car, well, Ian, you and I have now got electric cars, so we don't fill up anymore in that way. But the fuel prices have come down. I remember diesel was close to £2 a litre, and now I think they're about £1.60 last time I drove past one. The point I'm making here is there is a lag in the system. The swap markets are proving to be more confident in the housing market, and they are seeing those rates coming down. Andy earlier alluded to interest rates. If you're buying a property as a residential mortgage, there's rates below 4%. Some people might think, well, the base rate's 4.25. How can I get a 3.79% mortgage? Well, that just shows how the markets are moving and how lenders are funded and what balance sheet that they're using to then move those mortgages on. So I think personally, interest rates are still going to be going up from a Bank of England perspective. If you want to know the figure, let me know. I'm not going to burst it out. But I think interest rates from a lending perspective is certainly coming down. And we're seeing that both in the residential space and the buy-to-let space.
Interesting. There's a lot of points there. Andy, what's your take on things at the moment? Talking to developers and people you're talking big finance moves for some of these developers. You know, what's your thoughts? And Ryan just checking in there and saying thanks for the advice and the answers. Appreciate it, Ryan. Thanks for your question. Yeah, Andy.
First and foremost, I'm going to go against Akhil. I think mortgage rates are going to start coming down. That's my opinion. But
he said the base rate, I think, might keep going up rather than interest rates. I think
the base rate will stay as it is.
Okay,
that's my prediction. We'll have a beer on it at the end of the year. I don't think it will go higher than 4.25. That's my opinion. I'm not the mortgage broker, but it's just from people I've been speaking to. What do I think?
One day, Andy, I'm going to be expecting, or a few.
It depends how high it goes. If it goes high, it would be one. If it goes low,
one beer for every 0.5%, I think, has got to be the rule.
New Homes World. New Homes World is very, very good, apart from possibly the biggest elephant in the room, the P word, the planning applications, the planners, the councils, the local authorities that are just ridiculous in what they are refusing, taking time to pass, taking time to give approval for. And every developer I speak to have got not one good word to say about local planners. I'll give you a very quick. I don't know if anybody watched Clarkson's Farm and the hoops he had to jump through for a building that was already built on his land that then got refused. That is the same for every single council around the southeast, and I'm pretty sure going up north, going further north, from the developers I'm speaking to, is that the councils are just. I don't understand. And then these are the councils that are all moaning that they're going bankrupt. They've got no money. Well, if they gave planning applications, they'd be getting seal payments. They'd be getting the council taxes from the houses when the people have moved into them. Yeah. You know, it's a no-brainer. But you know, there's a development we had and we've just sold at the moment where the developer had planning for it, and the parking was a complete mismatch. It was just ridiculous. Whoever at the planning office put the parking in and approved it must have been looking at something through Mr. Magoo glasses. So the developer had to go in and change the parking. Now, this change of parking, it wasn't an increase in parking. It wasn't an increase in anything other than it was a betterment to the development. So there was 13 parking spaces, and the redesign was still 13 parking spaces, but better laid out. That took 6.5 months to get approved in planning.
It's crazy, isn't it? It is crazy. I was talking to Lee from Kirtland on the Landlord Page podcast. I had an episode with him the other week, and we just kind of were having the same conversation about planning, and he was pulling his hair out with it. But it feels like that needs to be privatized, like that part of it. It needs to go through a company. It needs to go through not the council. It needs to go through someone that is going to logically handle it for the council, because it just seems so archaic to have it still sat with some sort of council officer that's probably, you know, they're stretched because they're having to do everything, TPOs and extensions and a change of window down to massive sites. It just doesn't seem to make sense with these councils that's the way.
This planning officer, I won't say which council it is because I don't want to fall foul of them, but this planning officer, if he's watching, he'll know who I'm talking about. It's a he. He works 2 days a week. And this is for a big borough. So if you think everything that they've got to go through, this is a part-time job for him. He's self-employed. He's got his own job doing. I won't tell you what he's doing because that'll give it away. But he's got his own job. So he does that 3 days a week. And part-time work is the local planning for one of the biggest councils in Buckinghamshire.
Yeah, it doesn't seem right.
How does that work? Yeah. But they're doing it to save money. But it's a false economy because they're actually losing money because they're not getting money coming in from the applications that are being made.
Yeah. And Andy, share with Akhil your golf course versus home stat, because it blows my mind every time.
I know this one.
Go on then.
Yeah, there's it's about the land mass of golf courses, isn't it, across the country?
Yeah, I think there's 3 times. I can't remember the exact figures now. You've got me right on the spot. I think it's something like there's 3 times more golf courses in the UK than there is land covering property.
Yeah. Well, only 10% of England's built on, as in residential, which is phenomenal. It's all brown.
It's less than that, mate. It's less than that, residential. Yeah, residential is less than that.
You know, talking about, so we know planning, the planning system is archaic, it's old, it's not fit for purpose. But a lot of our clients that were doing ground up developments have now moved into, and this is not just recently, but in the last 24 months, into converting properties. And they find converting properties is a lot more straightforward. You apply for prior approval, 56 days, you can then march on. Because the problem here is with ground up developments, I'm not going to knock them because I love new build developments. I live in one now. But the problem is, as a developer with a financial hat on, you put a planning application on the 1st of Jan, you don't know when it's going to get approved. And then the problem with that is the costs you can't foresee in 12 months' time because they're only going to be going up. But how do you budget and how do you do a cost appraisal on a site and then look for funding for 12 months later, for example? It's just so archaic. But, you know, a lot of our clients are taking up the prior approval route, doing office to residential conversions, industrial units, converting large Victorian houses into 8 flats and so on and so on. And it's quicker. It's quicker. The costs are lower. Problem is when you dig into the ground, you just don't know what's going to come up, right? And then that then affects the bottom line. So something to look out for.
Yeah, but the problem with permitted development, that's what it's called, is offices to resi. A lot of lenders are now quite against it.
No, you are right. If there is an oversaturation in certain towns, and I totally agree with that. I totally agree. But the problem is, if you haven't got councils approving sites.
Oh yeah, where'd you go? What'd you do?
You're right. We know we've got a shortage of housing. It's a catch. You know, you can't win either way. To be honest with you, I'm not a huge fan of office to resi conversion because they still look like a bloody office block from the outside.
If you can get them, if the developer can do it and make it work on converting them into rentals, I think everyone's winning at that point. If you can do the build to rent or the convert to rent, whatever the phrase may be, there's such a huge shortage at the moment of rental properties. Like, it is out of control, the little amount of rental properties that are now available, and for a variety of different reasons, but it's been made so difficult to make buy-to-lets appealing that now it's 2 for 1, maybe even 3 for 1 on exit to the market to intro to the market. And tenants are now struggling because they can't afford, and they're being gazumped. I mean, I've got my brother-in-law that is trying to rent a property at the moment, and they've just given up because they're just getting blown out of everything they go to. It's just, you know, it's absolute madness. So if you can turn them into rentals, then I'd say that's a much better win. Andy's saying 4.25 is where the base rate holds. My gut feeling is we may see in May it creep to 4.5 potentially as a sort of ceiling limit, is what I would think at 4.5. They might round it off there. Keel's smiling. He's definitely got thoughts on something else. He's got an ear to the ground with someone here. What's your guess?
You boys, your guess is as good as mine, to be honest with you. But you know, we're probably going to get a few switches off now in a minute. But I think by the time we're eating our Christmas turkeys and chickens and lambs, so this year December, I think we're going to be at 5.5% base rate, if not 6%. And the reason why I say that is very simple. The RPI index, they keep increasing retail pricing. Inflation is not going to halve as quickly as Mr. Sunak thinks it will. There's just too much global problemness out there. And I can't see it getting sorted in the next 2 or 3 quarters. So unfortunately, I think 5.5. Listen, I always say plan for the worst and then figure it out. It's not going to be good for those people that are coming off mortgages. I've got a mortgage coming off in the summer this year and then another one next year. So we've got to deal with that. But investment, you know, how can we create further passive income? You know, we're all investors. We're advisors as well. I still think there's ample amount of opportunity out there to create passive income. Property is not passive. You know, you still have to work on the property. But it does mean you're making money while you are sleeping indirectly. So that's what I mean by passive there. You know, different types of tenancy agreements, HMO, service accommodation, Airbnb rentals. There's lots of ways of cutting up the cake.
I think a lot of people have held, especially the middle class, which is where the property owners are. The middle class don't like to be in debt. And I think a lot of them have held money to one side in the likeliness that utilities will go up over this period of time. Looking at inflation across other countries in Europe, it is reducing. We are an anomaly in Europe at the moment, where ours is not dropping like it is for the rest of Europe. So my hope is that we'll follow suit at some point. I think.
Ian, what are the investors when they call the Avo offices? You know, what's the trend at the moment you're seeing? What type of properties are they after?
it's a massive variety, but the new investors that are entering the market, I'm not talking to too many seasoned, buy to let landlords that have got 3 or 4 that are looking to add another 3 or 4.
Right.
I'm still talking to people that are dealing with huge portfolios of HMOs and build to rent. A lot of people are trying to really get into build to rent at the moment.
Yeah.
But the new investors that seem to be out there are mainly limited businesses that have got pots of cash in their companies, and they're looking to utilize it in some fashion or another. Obviously, the way that Rishi set things up for limited businesses, it might not be the most appealing way to do that now, where it used to think a limited business was the best vehicle to put it through. Now maybe it isn't. It might be better in your personal name now and pay the hit on the tax, but that's another question. But most of them seem to be looking at things that they can refurb. They're looking at probates, they're looking at stuff that could be extended, refurbed, and they're looking to effectively buy something, rent it out, probably do it on a 1-year finance deal, and then refinance it with another 10% worth of equity in it from the work they've done.
Okay. Yeah, because what we're getting a lot of inquiries for finance is permitted development. We're looking to buy a property, add some value to it via refurb, and then refinancing out. So I think that's quite trending at the moment. That's been trending for the last couple of years. Next year, I think will be trending will be repossessions. People that are distressed, can't afford the mortgages, and they're just going to flog them, which might mean it gives everyone, the investor or even the new homeowner, the opportunity to buy something below market value and get them on the ladder, because interest rates are going up. People are coming out of these 2 and 3% rates, and they're going to be doubling up very soon, and it might not be affordable, which is not going to be happy days. But I think that might trend going into next year. I think the EPCs have been taking a back seat now. That conversation around moving from E to a C, I think they've put a backstop on that. And, well, I thought that was going to happen anyway, to be honest with you. It's just too much going on, and a costly exercise moving those from E to Cs, which I think that's good news.
Yeah. Stu's got a question here, one of the Avocado partners who covers Maidenhead. We spoke about this off camera, actually, but he said, do you think other banks will change their lending restrictions like HSBC, Barclays and Accord have done to allow people to have mortgages up to 80 years old?
Yeah. First of all, we've got an aging population. People are dying a lot later, which is great. Okay. Personally, if you look at the tax receipts from the economy stance, what the Chancellor brings in, they want more people back into work. Retiring at 65 is pretty young in my eyes. It doesn't mean you need to work 40 hours beyond 65, but even 20 hours is good for health and well-being, I believe. It's good for the economy, and it keeps things ticking over. And we talked about it off camera. The longer the term of the mortgage means your payments are lower for that duration. Yes, the flip side is you're paying interest for a longer period of time, but it doesn't mean you're going to, if you buy, for example, if you buy your first property at the age of 30 and you go for a 40-year mortgage, it means your house is debt-free if you keep up the payments at the age of 70. But it doesn't mean that you can only become debt-free at the age of 70. If you make those overpayments, you might be fortunate and have an unencumbered property at the age of 60. But good things that banks are doing are increasing the criteria to 80 years old. And to be honest with you, this is not a new thing. Accord have always done 80 years old. And Santander done 70s, and more lenders. I think Shawbrook got up to 99, I believe, for buy-to-let. I haven't got a 99-year-old buy-to-let landlord yet, but you never say never. But this is common. I think it will certainly happen more and more. I think 1 is because of affordability. I think 2, because people are living longer. I think 3, because parents and grandparents are helping their family members out, so they have to refinance their home and so on and so on. So later life lending, also known as equity release, also known as, but yeah, I think it's a good thing that's happening in the market for sure.
Yeah, I think it gives people the option. I think that's the thing for me on it, Andy. I'm thinking, do I want a mortgage when I'm 80? No. But if I had a mortgage over 20 years rather than 40 years and I was paying twice the payments, I have to pay those. Whereas if I did it over the 40 years, and I sort of sandbanked the cash that I'd be paying over a 30-year term, for example, it's in my savings account. I can do the 10%, 20% overpay at the end of the year. Or if I couldn't afford it that year, I'm not defaulting on my mortgage. I guess that's the appeal, isn't it? It gives people the option, really, Andy, is probably the way we look at it from the outside.
If you've been paying into a pension since whenever, sometimes, the pension payments may well cover the mortgage costs when you're 75, 80. So it's yeah, I'm all for it. You know, the longer the term, the less you're paying over the term, rather than banking into a big lump sum that you're bailing out of, or you're bailing into. So yeah, I'm all for it. So I don't think it's a bad thing.
Yeah, absolutely. Got questions coming in now, late in the chat. So Matt's asking, if people are looking to do a let to buy, effectively rent their property out, Akhil, and purchase another one, what's the variables around it? What's the classic kind of criteria from the banks for that sort of finance move?
Okay, so let to buy, for those viewers that don't know what it is, you currently own your main residence. You've now decided that you want to keep it, turn it into a buy to let, and then your new onward purchase will be a new home. So you're letting your current property in order to buy a new one. Rule of thumb is you need to have enough equity in your current home to convert it to a buy to let mortgage. Rule of thumb, minimum 25% equity. So if your current home is worth 400, you need to have at least 300,000. You need to have at least 300,000 or less mortgage currently outstanding. It would be subject to the rental income. So the rental income on a buy to let stress test will need to meet in that example, the 300,000 mortgage. So equity versus loan to value is key. With regards to other criteria, 99% of the lenders want you to have a simultaneous completion. So you rent out, you complete on your current mortgage to a buy-to-let on a Monday, you will then move into your new home the same day. So it's a simultaneous conversion of mortgage and then a new home purchase simultaneously. There are times where there's change in circumstances, whereas the client now wants to put their property onto a buy-to-let, and they want to move in with their parents because one of the parents is elderly or something along those lines, they need support. Lenders can take a view on such a thing. So if they already own an existing buy-to-let, they're not classed as a first-time landlord, so they've got experience. The lender just wants to ensure that the client is not trying a quick one and wants to come out of a residential mortgage and move on to a buy-to-let, but still live in that property because that becomes regulated. So they just want to make sure that the person is actually exiting it and moving for the right reason, and there is a simultaneous purchase on the other end. It's certainly a trending thing. It's always been trending. Let to buy is nothing new. Most lenders will allow you to change the product if they do offer a buy-to-let range. All the high street, all the building sites do so that's good news. Loan to value, as I said, buy-to-let 25%. That's the key there. Your new onward purchase can be as little as 5% deposit. Subject to you having enough income.
I wish that with my first property, I'd made the conscious decision to let to buy all the way up. I actually worked it out probably about 9 months ago, and I'd have had about £2 million worth of equity if I'd have done that the whole way up.
Oh man! But listen, it's good that this is why I like these sort of channels and the information that you guys put out there, simply because we're putting information out there for people to start thinking. And we come across so many questions on a daily basis. Oh, I didn't know this, or I was told this. Some of it's right, some of it's wrong. And it's shocking because it's not true or it is true. You can do this, you can't do that. And this is another prime example. This is how buy-to-let model was actually created by the accidental landlord that couldn't sell their property. It was a chain break for whatever reason. They thought, you know what, let me just rent it out for a couple of weeks and then sell it tomorrow, a few weeks after. But they just retained the property because it became a passive income business concept. But that's how it actually came about, let to buys.
Interesting. Yeah.
Here's a question I was asked. This again goes back to a lot of people's naivety. The guy phoned me a couple of days back and said, my current mortgage rate is just over 2% on a fixed rate and it's due to expire in December. Does that mean my mortgage is going to double? My payment's going to double if my mortgage rate goes up to 4%?
No, it's not going to double. No, it's not going to double.
But this is where I'm going back to naivety and people not understanding. A lot of people I've spoken to think that because they've got a mortgage rate at 2%, that mortgage rate then going up to 4%.
Yeah.
Their payments might be £1,000. Their payments are now going to be £2,000, but that's not the case. And this is what people need to understand is just because the mortgage rates are going up, it doesn't mean your payments are actually going up by the incremental amount.
Yeah, there's lots of, and even if it is the case, there might be a view that we can extend the term out for that short period of time to keep the payments in line with the affordability. So that goes back to extending the term out to the age of 70, 80, and so on, depending on the lender's appetite. But again, having those conversations early on. So that prime example, that guy's got his mortgage coming up in December. Right now, we couldn't tie him up into a new deal with the current lender. Usually 6 months prior, you can do it. So he's a bit early. But now's the time to having these sort of conversations to say, well, if my mortgage is coming up in 2 months' time, what does my new payment look like with my current lender? Option one. Option two is if I refinance to a lender B tomorrow, what do my costs look like? And then that way, at least he or she knows what they're heading into, because December's only around the corner.
We've got a question coming from LinkedIn, actually. Streaming on the LinkedIn channel. Mortgage with business accounts. Do you need profit for the last 2 years, or can banks consider, in brackets due to COVID, on the last year of profit?
Okay. So again, most lenders will take into account what's stated on your tax calculation, also known as the SA 302. So that would be the combination of salary and dividends. If you've got rental income in the background, you would have declared your rental income profit, and they'll take into account salary, dividends, and rental income profit. If, for example, your business accounts have made losses in the background, well, things happen in businesses, but it's what you've declared on your annual tax return personally that the lender is going to lend based on. If we were going to use profit, well, if you've made negative profit, then there is no profit to take into account in the affordability. So it's one of those that we'll need to see the latest 2 years tax calculations, as well as the last 2 years profits, the 2 years accounts, and then we can take a view. But the likelihood is we'd use salary and dividends if they're a limited company, or it would just be salary if they were a sole trader, because the profits will be negative. So get in touch, I would say, and then we can look at the details in the accounts.
I think that's always one of those where you need to look at all the cards on the table.
Yeah.
It's like top trumps, isn't it? You need to individually talk to the client, see what the best case is to put forward, and then pick the highest top trump. And that you need to talk to them individually on. So reach out to Akhil and he'll be able to help you out. Got Ricky's actually just thrown in with a little bit of a funny.
I love this.
It's a serious chat. And Albana, I'm going to say.
Albana Lashi.
Yeah. So Ricky has said, why do all mortgage brokers claim to be able to work the whole of market?
Yeah.
Can they really be the whole of market? Likewise, can they all receive exclusive rates? It's the tagline, isn't it?
Yeah, no, I like this. And this is, Ricky, thanks for raising this. And this is, I love this question. And so for example, if someone classes themselves as whole of market, and they're not, they're actually falling foul of the FCA guidelines. So our mortgage broker are genuinely whole of market, and we are totally independent. What does that mean in English? We're not tied to any specific lenders. We're not tied to any specific panel of lenders. We have access to every single lender in the market. And if anybody that's watching this and they work with mortgage brokers, ask them the simple question: do they have access to the likes of HSBC, Bank of Ireland, and TSB? If they don't have access to those three lenders directly, and I mean directly, not through a packager, which some people do, we don't, they're not whole of market for that reason. Lenders that I just mentioned, those three, are very specific who they work with, and it means that the brokerage are of a certain caliber, they're writing a certain level of business, and they are compliant in so many other ways. And we are a directly authorized business, so we don't have an overarching company that oversees our compliance or our processes. We are directly authorized by the FCA, and we are whole of market genuinely. So I would be very skeptical of people that say that. I'm not going to say not everyone is or everyone is not, but just ask them the questions. Do they have access to HSBC, Bank of Ireland, and TSB directly? Then they're genuine. Then there's a good chance that they are whole of market. With regards to, again, exclusive rates, it's very unlikely to get an exclusive rate unless you are a ginormous company and you're doing millions and millions of mortgage applications each and every year. There are super large firms out there, more online based, that have exclusive rates. We don't get exclusive rates because we're not on that par just yet. But what we do get is semi-exclusive rates, which means the lender has got a pool of brokerages that they work with. It could be 2, 4, 10, or 20 brokerages that they're giving you a specific deal that you can offer these to your clients, and you're on a semi-exclusive basis. So again, it does come up. They are available. They don't come up each and every week, but we have semi-exclusive rates that we do offer to our clients, where the average Joe can't get them either direct or through their local mortgage brokerage. But it's a good question.
Yeah, it's a great question. I love that, actually, because we've been in agency for a while, Andy, and that's one of the old classics, isn't it? Yeah. Talk to my broker. He's whole of market and gets exclusive rates. So talk to my estate agent. He wears a tie. Brilliant. Yeah, love that. Absolutely love it. Well, yeah, we've had some great questions there. So yeah, Ricky, thank you. Albana, thank you. Matt, you came in with a good question there. Stuart, one of the Avocado partners as well. And Ryan, great questions too. I've been thinking for 50 minutes about a joke about a Leeds fan, a Chelsea fan, and a Liverpool fan going into the weekend together on a live call, but it's so depressing for all three of us, other than Leeds had a decent result the other day. But let's be honest, it's not been a season to remember for any.
It's been terrible, mate. It's been terrible. But listen, there's only one way up now, so we can only turn it around. So who's your next manager? Who's the next manager coming in, Mr. Blue Flags?
Well, Lamps is in, isn't he? Lamps is in for the next 11 games, potentially more if we knock Real Madrid out of the Champions League final. So
well, they just beat Barcelona, I think, last night 4-0. So you've got some work to do there.
Don't worry about Chelsea in the Champions League. We're always all right. But Leeds went from like nearly bottom of the table to 13th with one win. I mean, it's so tight in relegation. You still confident you're going to stay up, Andy, or are you getting cramp and you're crossing your fingers and your toes?
No, we'll stay up. We're I know it's an old cliche, but we are playing too good football to go down. And there are a few teams below us that are absolute pony at the moment. So we've got a big game on Sunday against Palace. So that's a big 6-pointer. And then the week Monday Night Football, Leeds Liverpool at Ellen Road. Yorkshire versus the Scousers. Who's going to win?
Well,
I know where my money is, bearing in mind how bad you lot are playing.
Yeah, I think as well. We got Arsenal on Sunday first and foremost. I'm looking forward to playing those guys because they're having an exceptional year, right? So and it's quite a big one because it's Liverpool, Arsenal, then Arsenal got City. So City could be 1 point ahead, I think, or 1 point behind them, I think, after 2 more games. So
I think the thing is, every game at the moment rests on something. I think there's only Aston Villa that can't get into Europe or won't go down. But every other team could either get into Europe or could get relegated.
Oh,
yeah, imagine if Chelsea got relegated. That would be fun.
Oh, that would just make my day.
Well, that'll half your season ticket price, wouldn't it? At least half it.
Yeah,
It'll only be £3,000 then, rather than 6.
Might actually get a ticket, mind.
Yeah.
Oh dear. Well, there we go. We could talk about football for another hour, but we won't. We're going to go and eat some Easter eggs. The sun is out. It's blue skies outside. The bank holiday is about to start. It's nearly 7 o'clock and it looks beautiful out there. So for everyone watching, thanks for joining us. If you're watching on the recording rather than the live, we'll still answer any of your questions if you pop them in the comments. Special thanks to Andy. Special thanks to Akhil. Thank you for joining us the evening before bank holiday. Go and enjoy a well-earned rest if you get it. And we will all speak again soon, I'm sure. But yeah, thank you, Akhil and Andy. I'm sure we'll have some banter about football now that Lampard is involved somewhere. So everyone have a lovely bank holiday weekend.
Have a good one. Bye.
Cheers.